Welcome back to another episode of Beyond the Numbers. I am Chris Thompson, and as ever, joined by my esteemed colleague and friend, Mr. Tom Biggs. And it feels like we only did one of these videos just yesterday, which was on the autumn statement predictions. And I have to say, it was possibly one of the most glib statements I've seen in quite a while in the House of Commons by the Chancellor, Jeremy Hunt. And yeah, I think basically it sounds like we're in recession already, and that may last for over 12 months, maybe up to 18 months, 2 years. And to be fair to you, Tom, your predictions were pretty accurate. The only ones that I can think of that didn't quite hit the mark were non-doms.
Yeah,
maybe a little bit around capital gains tax and inheritance tax, but I'm going to let you explain what might be coming on those in the future.
Yeah, so morning, Chris. As you have suggested, so non-dom status was something that we thought might be looked at in the autumn statement, mainly because it's a fairly easy political win, especially with a general election on the horizon. Now the non-dom status has been retained, so there isn't the abolishment of that as we were sort of anticipating. Yeah. However, I think the Chancellor mentioned that the reason why, or part of the reason why it's been retained, is that the OBR couldn't provide any forecasts as to what abolishing that particular policy would mean. So effectively, there was a massive amount of uncertainty as to whether it would be successful or not, I guess. So, you know, with the general election on the horizon, it's certainly something that Labour are pushing quite hard on in terms of getting rid of it. So depending on the outcome of that election, there's no reason to think that that might not come up again at some point.
Sure.
So that one didn't come to fruition.
Do you think he might delay it till the spring, because there is a spring budget due usually around March time?
I think it's a possibility, and it's one of those things where you wouldn't ever take it off the table. I think given his stance, unless the OBR can provide forecasts as to the impact of that policy, I'd be surprised if it came back in that quick. But you know, you never know. If they actually turn around and say, well, actually, we think it's going to make a sort of fairly big impact, then it might well come back on the table.
And when you talk about impact, what you're saying is they need to know how much tax revenue would be generated if, say, the non-dom status was scrapped.
Yeah, that's right. So all of the policies that are announced as part of the autumn statement, they all come with policy costings, effectively, which outline what either the cost or the income, if you like, to the Treasury is of bringing in those policies. Yeah. So the statement itself that you kind of see on the telly, that's kind of one element of the autumn statement. Then there's an awful lot of documents that are released afterwards that provide all the sort of further detail, including that policy costing. So you're right, yeah.
And this is the problem with the Liz Truss quasi-Kwarteng mini budget, is that they put the Office of Budget Responsibility on suspension or hold.
Yeah, correct. Yeah.
So there were no figures for the impact of their policies, and hence the bond market, where the government go and borrow, blew up, and our rates started to skyrocket. Okay, so that's non-doms, Tom. How about capital gains tax?
Capital gains tax, I'd say we got this partly right, Chris. I'll stand up for myself a little bit here. So we were anticipating that capital gains tax rates might go up, linked to the report that the previous Chancellor, Rishi Sunak, he commissioned back in, I think it was back in 2020 or 2019, before the pandemic, in regards to putting capital gains rates up to align with income tax. This is something that we thought might now come back into play, given he's now in the driving seat as Prime Minister. But again, this didn't happen. Now, why I say we partly got this right is that we also talked about capital gains exemptions, and then them sort of being looked at. Now, that was introduced as part of the autumn statement, or will be introduced, should I say, subject to sort of legislation being passed. So what's going to happen there is that the annual allowance for capital gains tax, which is currently 12,300, is going to be cut to 6,000 from April 23. And then further to that, in April 24, that's going to be cut again to 3,000. So effectively, within a couple of years, we're going from having £12,000, give or take, as an annual exemption. So you can effectively realise £12,000 of capital gains in a year without paying any capital gains tax. That's going to come right down to 3,000 from April 24. So quite a big cut, to be honest. Whilst the rates haven't gone up, that's sort of a fairly big cut, and will bring a lot more people within the capital gains tax regime.
Sure. So if I had some quite expensive items, for example, or assets, and I've been thinking about maybe disposing of them, selling them, timing could be everything.
Yeah, it's certainly worthwhile thinking about that, and at least thinking about taking some advice. Now, obviously, tax isn't necessarily the only consideration with these kind of things, but given these changes to the allowances, it's certainly worth thinking about.
And presumably, I mean, it's all very well saying I have these assets and blah, 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 and I might be looking to sell them, but one has to look at it from a maybe more holistic point of view in terms of my own personal circumstances, affairs, my family.
Yeah, exactly.
Inheritance and all that kind of stuff.
Yeah, there's an old saying that we have, which is "Don't let the tax tail wag the dog," and I think that's always worth keeping in mind with this kind of thing. Is that you kind of see the changes in tax coming up, and that sometimes can sort of drive decisions, which isn't always the right thing. So it's always worth looking at things holistically, like you say.
Good. So that's CGT, Tom.
Yeah.
And talking of inheritance, so IHD, inheritance tax, anything there?
So again, I'd say this is similar to capital gains tax, and we got this partly right. So I'll address the partly right bit. We talked about the nil rate band being frozen beyond April 26th, I think it was, that it was previously announced. This again was announced as part of the autumn statement that that's going to be extended to April 28. So the nil rate band, or the standard nil rate band, should I say, that's £325,000. That's going to be in place at the same level until April 28.
Right.
Now, one thing to note with this, as a sort of interesting point, if you like, is that it's been that same level, £325,000, since April 2009. So effectively, we're going to have best part of 20 years of the nil rate band being at the same value. In the context of asset prices obviously going up, so we'll come on to this in a little while, but it's a freeze, if you like, but it's what we call a stealth tax. So it's effectively more, it's an increase in tax, but not necessarily through the headline rate of tax going up.
Yeah. So it effectively drags more people into the tax regime, if you want to call it that. Is that the right choice of words?
Yeah. I'd say so. Yeah. That's a pretty good summary. Effectively, as if you look at it with inheritance tax and say capital gains tax, for example, as sort of asset prices go up, if the exemptions and thresholds remain the same, then broadly you'd expect more of those assets to be dragged in. Similarly, if you look at sort of income tax, national insurance, dividends, that kind of thing, as income goes up, as wages increase with inflation, hopefully is the expectation, with the rates being frozen, more people will then be dragged into certain rates of tax. So
Sure.
So the rates haven't gone up, the thresholds haven't gone down, but because they're remaining static whilst income is going up, more people will get dragged into it, effectively, is what we're saying.
Indeed. Now, on that note, this was therefore a very stealthy statement, wasn't it? Because it's not just the IHT threshold that's frozen; it's other things too, income tax being one of them, right?
Yeah. So the income tax thresholds, certainly the higher rate threshold, the personal allowance, that's all being frozen until April 28.
Yeah.
Similarly, with national insurance, the primary threshold, the upper earnings limit, the upper profits limit, that's been frozen until April 28 as well.
Yeah.
No, just before we sort of move on, because there's other sort of freezes as well. Just with income tax, the additional rate threshold, which is the rate the point at which you start paying 45% tax, that's currently at £150,000. That's being cut to 125,140. So it's quite a big cut there. Not just a freeze; it's actually a cut in terms of threshold. Which will add up to up to £1,300 of additional tax for additional raters. So there is a cut there, but broadly everything else has sort of been frozen out until April 28 under that sort of stealth tax sort of approach that you mentioned before. Now VAT.
Just a second, Tom. Sorry. So just sorry to interrupt your flow. So if you're in that sort of territory of income or earnings, I mean, yeah. What can you do? Presumably, there's things like pension contributions that you can look at to potentially, obviously, depending on your circumstances, potentially lower your tax burden.
Yeah, so you got pension contributions is one. You might want to think about charity donations if that's something. There's a few things you can consider.
Sure, and this is to ensure you don't jump into that higher rate band.
Yeah, that's what I mean. The fact that the additional rate band has now come down to where it is.
Rate. Yeah.
The reason the fact that it's come down to where it is arguably even more important to think about tax planning, because just before the additional rate now is effectively the band between 100 and 125,000, at which point you can be taxed at an effective rate of 60% because you lose your personal allowance within that band as well.
Yes.
So it's not necessarily just dropping you down below 125, because you're then in potentially within an effective rate of 60%, which is obviously quite penal in itself. So it now more than ever is more important to sort of think about tax planning to sort of try and manage that liability. Definitely.
Yeah. So you're trying to get sort of below the 100K mark or around there.
Yeah, ideally, yeah. Again, kind of like we touched on earlier, there's obviously other considerations as part of this, not purely your tax rate, but it's getting yourself down to that level. You would then retain your personal allowance, and you would be in the 40% rather than 45% rate. I mean, there's a few other factors as well, but broadly that's kind of how it works.
Yeah, as a general overlay of what's going on. Yeah,
that's right. Yeah. So just coming back around to what we were talking about freezes. Next one I was just going to mention was VAT. Now this wasn't mentioned on the in his actual statement in the House of Commons, but the VAT threshold is also being frozen.
Yeah, so it's the fine print, Tom. The fine print that you've been combing through.
That's right. Yeah, it's it's quite a long read, if truth be told, but it's got to be done. So the VAT threshold, which is the point at which a business has to register for VAT, it's currently £85,000. That is being frozen as well until March 2026. And the impact of that, it's similar to what we spoke about with income tax, as prices increase, as business prices increase, potentially more people will get dragged into the VAT regime. With the admin of doing VAT returns, that kind of thing, but also actually it might well to the end consumers also push up prices if the business isn't going to effectively suck up the additional VAT, which is quite an interesting point, because part of what the Chancellor was talking about in his statement was trying to address inflation and bring that down, because that's clearly quite a problem at the moment. But freezing VAT arguably could push up prices in certain areas as well. So it actually could have the opposite effect. So
it could actually be inflationary in the short term.
Could be.
Yeah.
Interesting point really, I suppose. So they're the main freeze. There was a couple more within business rates in terms of the multipliers for working out your rates being frozen. But there were sort of other sort of transitional bits there. But yeah,
all of which are detailed on our blog.
Yeah, correct. Yeah. But yeah, I mean, the main sort of freezes we've seen is sort of within income tax, national insurance, inheritance tax, those sort of bits really.
Sure. Yeah. Okay, Tom. So it is a bit of a downbeat budget. He did warn us that that we could expect tax rises and spending cuts. It seems like the spending cuts have been put back to the sort of latter part of this, I can put 5-6 year period.
Yeah, seen that way.
So there's that. I think the only other one that springs to mind, Tom, maybe you could run through a little bit of, is the dividend tax changes.
Yeah, so dividends. The dividend tax changes was actually what, I guess a cut, if you like. There was a couple of other cuts as well. I'll come on to in a second. So currently you can earn £2,000 of dividends in a year and not pay any tax, called the dividend allowance, which means that it's not an exemption as such. It's just that you're taxed at a rate of 0%. It's kind of technicality, but broadly you won't pay any tax on it. Now that is being cut to £1,000 from April 23, and then is being cut again in April 24 to £500. So, effectively, it's being cut quite a lot, and it's mainly to address what's sort of perceived as a sort of tax avoidance motive of sort of people taking out a low salary from a company and then topping up with dividends, typically where you're an owner managed business, which obviously a lot of our clients are. So it's aimed at kind of tackling that and trying to sort of balance out the people who are on salary versus people on dividends, that kind of thing. So it's kind of part of that agenda a little bit.
Sure.
So we've got a cut there. We have spoke about capital gains tax earlier on. An important one to note here as well, excuse me, is in regards to research and development tax relief for companies.
Very important one, Tom, for some of our clients. Yes.
Yeah, massively. So, again, this is an interesting one, because the Chancellor stood up and said he wants Britain to be the next Silicon Valley, which is obviously going to rely on quite a lot of innovation. And then
we're going to get another Musk, are we?
Yeah. He's then gone away and chipped away at R&D relief, which the whole point of it is to encourage innovation and development, that kind of thing. So this one didn't really make much sense to me, but maybe I'm missing something. So with the SME R&D relief, you currently get, in broad terms, an additional tax deduction of 130% of your qualifying expenditure. Knocked off your profits for tax purposes. That is going to be cut to 86%. As a result of this auto-sustainment, which is that's obviously quite a big change, to be honest, going from 130 to 86, needless to say. But on top of that, the repayable credit, so where you're a loss-making company, you can surrender some of your losses for a repayment from HMRC. That rate is currently 14.5%. That is going to be cut to 10% as a result of the autumn sustainment. So again, it's sort of being chipped away at there, which overall we haven't fully worked through the numbers, but it's probably going to be quite a big difference in terms of what cash the company is going to get back. Now, linked to that as well, and as the Chancellor sort of had previously alluded to, the R&D sort of scheme generally is being a bit more targeted to be sort of focused on UK development rather than overseas. So qualifying expenditure is being restricted slightly in that externally provided workers need to be broadly UK based on a UK payroll. And similarly, subcontractors need to be UK based as well. So you won't be able to claim overseas subcontractors. Now, there will be an exemption, the details of which is yet to be announced, regarding development that can't be undertaken in the UK. So if there's a genuine reason why you're using overseas contractors, for example, you'll be able to claim them. But I would expect that that exemption is going to be fairly limited. So that was no real surprise, because it had been alluded to before about focusing everything on sort of UK activities. But nonetheless, it kind of all links into the whole, I guess, point about the R&D scheme being, I guess, attacked, if that's the right phrase, whilst at the same time saying we want Britain to be the next Silicon Valley.
Again, does timing come into this, Tom, in terms of when you make your claim and when the changes kick in? And also, I think you alluded to it, that workers and even subcontractors need to be resident in the UK. I mean, presumably that means that you can't say with subcontractors or workers, bring them over for a time period, get them working in the UK and then send them back.
Yeah, well, it's gonna, again, with much of this, the detail isn't, hasn't been announced yet.
The full set of rules.
Yeah, they're just kind of broad policies at the moment. So we'll see when the detail comes out as to how it operates. So there might be workarounds. Again, it kind of comes back to that point we spoke about how holistic it is. If using the example that you just gave there, if it's a case of just bring someone over for a short period of time, whilst that you might benefit tax wise for that, there's obviously going to be additional cost to go with it. So it's not, it's not a one size fits all with this, but it'll be a case of just seeing what the detail is when the legislation is drafted and when the sort of legal process starts a little bit in terms of bringing it into law, really.
Sure. So more rules and even more rules coming forward.
I suspect so.
Wonderful. It's not like the tax book is full of them already.
Yeah, well, people like me, Chris, we enjoy sort of trawling through all the legislation.
You love it, don't you?
Got nothing better to do.
There's about 11 million words worth to trawl through, Tom. So keep you busy.
Yeah, that's it. Yeah.
Okay. Any more, Tom?
There was a cut. It's worth mentioning the sort of final point, just whilst we're on cuts, I suppose, in that there was a previous announcement that SDLT was being eased slightly in terms of sort of first buyer reliefs, the residential dim rate band, effectively all those bands where you're paying certain levels of SDLT were increased, which effectively means that you've got more, you've got more property value before you start paying SDLT and start paying at higher rates. That is effectively being brought back down to the original levels, which again are on our blog, from April 25. So that temporary relaxation to kind of try and get the property market going a little bit will again be abolished, if you like, and brought back to normal levels from April 25. So again, it's just worthwhile keeping that in mind, especially if you're thinking about moving or purchasing a property within the next few years. Timing of that might be quite important.
I was going to say yes, so that could stoke up a bit of demand and also times nicely potentially, a bit like the spending cuts to a general election.
Yeah, precisely. Yeah.
I smell a Mr. George Osborne semi-involved in some of this.
Yeah, could well be.
Rumour has it he was consulted, but just rumour, I might add. So, so very stealthy statement, very in line, like in the past with Gordon Brown and Mr. George Osborne, just mentioned. And I'll say, well, thank you very much, Tom, for that. And we shall see how things progress. Obviously, we've got the next budget in the spring, so there may be more changes to things like non-DOMs, tightening of IHT and CGT rules then, we suspect, as per your predictions. And I think you were pretty good with those, Tom, so well done. And be sure to check out our blog for all things to do with this statement, and also year-end tax planning, which we'll be working on, Tom. So keep your eyes open for that one, because obviously there is a lot that has been announced and probably more coming. Okay, Tom, thank you very much. Well done.
Thanks, Chris.
Cheers. Bye.
See you soon.